August is the one month of the year when most people stop thinking about tax entirely. The January deadline is behind them, the July payment on account has either been paid or dealt with, the October paper return deadline is still 2 months away, nothing urgent is pressing, and so August becomes the month when tax gets quietly set aside, filed somewhere in the back of the mind with everything else that can wait until later. That is exactly why August is the most valuable month of the year to act on it. Welcome back to HMRC Update, and today I want to explain something that sounds counterintuitive until you see the logic clearly. The people who deal with their tax records in August, not in a panic, not against a deadline, but calmly, with time on their side, consistently end up in a better position than the people who wait. They find errors earlier, they claim reliefs they would otherwise miss, they avoid the decisions made badly under pressure in December and January. And in 2026 specifically, there are 3 things happening right now in August that make reviewing your tax records not just sensible, but genuinely time-sensitive. If you are not subscribed to HMRC Update, please do that now and hit the bell. The things I am covering today have real deadlines attached to them, 2 of which close in August itself. Subscribe. Let us get into it. The first reason August is not an ordinary quiet month this year involves a consultation that is closing on the 4th of August 2026. And while consultations are not the kind of thing most people track, this one is directly relevant to anyone who files a self-assessment return and makes payments on account. The government is currently consulting on reforming payments on account in self-assessment, specifically exploring the potential for more timely payments. The consultation closes on the 4th of August 2026. Payments on account are the advanced tax payments made in January and July each year by self-assessment filers. They are calculated based on the previous year's tax bill, which means they can be significantly wrong in either direction if this year's income looks different from last year's. The consultation is exploring whether the payment system could be reformed to better reflect actual current year income rather than being based purely on what was owed 12 months ago. Why does this matter to you right now? Because if the consultation results in reform, and the direction of travel in 2026 strongly suggests it will, the way self-assessment tax is collected could change meaningfully within the next 2 years. People who understand what payments on account are and how they work will be better placed to adapt to any change. People who have never examined that part of their tax position may find themselves confused when a new system arrives without adequate personal explanation from HMRC. If your payments on account for January and July this year were based on a previous year in which your income was higher than this year, you have the right to reduce those payments right now. The reduction is applied through your HMRC online account or via the SA 303 form. A reduced payment on account that turns out to be too low because your actual income ends up higher than you estimated attracts interest at 7.75% on the shortfall, backdated to the original payment due dates. But a reduction based on genuinely lower current year income is legitimate and legal. August is the month to assess whether your July payment on account was proportionate to your actual 2026 to 2027 income, and to take action if it was not. The second reason August matters for your tax records this year is the paper self-assessment deadline and the way people consistently misjudge the time they have to prepare for it. HMRC must receive your paper tax return by 11:59 p.m. on the 31st of October 2026. You can send it any time on or after the 6th of April 2026, as long as HMRC receives it by that deadline. That is 13 weeks from now. For a paper return, 13 weeks sounds generous. In practice, the people who leave their paper return until October find that gathering the documents they need, P60s, bank statements showing savings interest, pension income statements, receipts for work expenses, takes significantly longer than they expected. Documents that should be in a filing drawer have been moved. Bank statements for savings accounts opened years ago require a branch visit or a phone call to obtain. P60s from a previous employer were filed at the old address. HMRC requires you to keep records for at least 5 years after the 31st of January submission deadline. That means records for the 2024 to 2025 tax year, the one you are currently preparing to report, must be retained until at least January 2031. August is the moment to consolidate those records while the tax year that ended in April is still relatively recent. The further you get from the tax year, the harder it becomes to reconstruct what happened in it, which bank paid what interest, which employer paid which amount, which expense was incurred in which month. Even if you file online rather than on paper, with a deadline of the 31st of January 2027, the case for starting your return in August rather than December is straightforward. You can submit your online tax return anytime on or after the 6th of April 2026 up to the deadline. Filing in August means HMRC calculates your tax liability immediately. You know in August exactly what you owe in January. You have 5 months to set that money aside or arrange a payment plan, rather than discovering in late January that the figure is larger than you had mentally budgeted. And if there is an error in your return, an income figure that does not match HMRC's records, a relief that needs additional documentation, you have time to correct it without the pressure of a days-away deadline. Drop a comment below if you have ever been caught out by the October paper deadline because you ran out of time to gather your documents. I want to understand how many people on this channel that has happened to, because the solution is simple and available right now. Back to what is specific to August 2026. The third reason to review your tax records this month is the one with the most direct financial value, and it is one that most people overlook entirely because it sits outside the standard list of things HMRC reminds you about. August is the optimal window to check your personal tax account at gov.uk for the current tax year position and identify anything that needs correcting before it becomes a problem at year end. Your personal tax account shows your current tax code, your income as recorded by HMRC from your employer and pension provider, any benefits in kind reported by your employer, your national insurance record, and your state pension forecast. Each of those things can contain an error, and an error identified in August can be corrected before it affects 12 months of payslips rather than just the last few months. Tax codes are the most common source of error. A tax code that is too low because HMRC has estimated your income too high, or because a benefit in kind from a previous employer is still being applied, or because a debt that has already been repaid is still showing as a deduction, means you are paying more income tax every month than you should be. That overpayment accumulates across the tax year and eventually comes back as a refund, but only if HMRC's records reflect the correct position. If the wrong tax code runs uncorrected for the full tax year, you are effectively giving HMRC an interest-free loan for 12 months and then waiting for the P800 reconciliation process to return what is yours. Checking your tax code in August, now, and correcting it if it is wrong means the correct deduction applies for the remaining 8 months of the tax year. The difference compounds. In your favor from the point of correction. If your tax code this year is not 1257L, the standard code for a basic rate taxpayer with no adjustments, there is a reason for the difference, and you should understand what it is. A K code means HMRC is collecting a debt or an underpayment through your pay. A D code means you are paying additional rate tax. A letter W1 or M1 at the end of the code means it is being applied on a month 1 basis, which may be appropriate if you recently changed jobs, or may be an error if it has not been updated. Log into your personal tax account at gov.uk and review the coding notice shown there. If anything does not reflect your current situation, call HMRC on 0300 200 3300 with your national insurance number and the details of what you believe is incorrect. There is also a consultation open right now on reviewing the circumstances in which employees can claim tax relief on non-reimbursed work expenses within self-assessment. The government is exploring whether the current requirement that employees with more than £2,500 of allowable expenses must file a full self-assessment return to claim relief is still proportionate. If you are an employee with significant unreimbursed work expenses, professional subscriptions, tools and equipment required for your job, costs of uniforms or protective clothing your employer requires you to purchase, August is the moment to review whether you have been claiming the full relief available. Expenses below £2,500 are claimed through the P87 form, which is available at gov.uk. Expenses above £2,500 are claimed through a self-assessment return. Both routes are available now for the 2024 to 2025 tax year that ended in April. The 4-year window for that year does not close until April 2029, but the closer you get to a deadline, the more likely you are to find the documents you need are harder to locate. There is one final piece of the August picture that applies to anyone who has savings. Generating interest in the current tax year. Because the personal savings allowance has been frozen at £1,000 for basic rate taxpayers since 2016, and savings rates have remained at elevated levels, a large number of people are in a taxable position on their savings interest without realizing it. In August, most people's savings accounts have been earning interest for 4 months of the current tax year. This is the moment to project what the full-year interest figure is likely to be. Multiply the interest earned so far by 3 to get an approximate annual figure, and assess whether it will push your total income above the personal allowance or above the savings allowance threshold. If the projection suggests you will owe tax on savings interest, the options available right now are wider than they will be in January. You can open a cash ISA, where interest is completely protected from income tax, and move savings across to shelter future interest from HMRC. The annual ISA allowance for 2026 to 2027 is £20,000. Interest earned inside a cash ISA does not count toward the personal savings allowance, does not affect the starting rate for savings calculation, and is not reported to HMRC as taxable income. Acting in August means up to 8 months of interest that would otherwise be taxable is sheltered instead. Acting in January means the tax year is over and the liability has already built. So here is where everything sits and what to do with it in August. If you file a paper self-assessment return, gather your documents now. P60 from your employer, bank statement showing savings interest for the 2024 to 2025 tax year, private pension income statements, records of any work expenses you intend to claim. 13 weeks to the October deadline feels adequate. It is not once document retrieval is factored in. If you file online, you can file now. The return for 2024 to 2025 is open for online submission at gov.uk. Filing in August gives you the tax calculation. 5 months before the January payment deadline, with time to plan rather than react. Check your tax code in your personal tax account at gov.uk. If the code is not what you expect, call HMRC on 0300 200 3300 to understand why and correct it if it is wrong. Every month the wrong code runs, the overpayment or underpayment grows. Project your savings interest for the full 2026 to 2027 tax year based on what has been earned so far. If it is likely to create a tax liability, consider moving savings into a cash ISA now, rather than after the tax year has ended and the liability is already fixed. And if you make payments on account and your income this year is genuinely lower than last year, review whether a reduction to your payment on account is justified, and make that reduction through your HMRC online account now, rather than waiting until the January balancing payment arrives with a larger than expected figure. HMRC does not write in August to say now is the moment to check your records. There is no August deadline that creates urgency. The urgency comes from understanding what the October and January deadlines actually require, and recognizing that the people who deal with it now, calmly, with 5 months in hand, consistently end up in a better position than the ones who deal with it in a rush when the deadline is already close. You now know exactly what to check and why August is the right moment to check it. If this video helped you, share it with someone who files self-assessment and usually leaves it until January. One conversation in August could save them a significant amount of stress and potentially a penalty they did not need to face. Subscribe to HMRC Update if you are not already here.